For the past couple of years, you've probably heard one thing over and over. Cash is king. I mean, why not? Those high-yield savings accounts have been paying out rates we haven't seen in forever. But what if that comfortable cash throne is actually about to get yanked right out from under you? Today, we're going to dig into why the golden age of easy cash might be coming to a very abrupt end, and, more importantly, what you can do about it.
You know, this quote just hits the nail on the head. Interest rates are a two-sided coin. When the Fed keeps them low, it's a huge party for anyone with a loan. But for savers, it's a disaster. And that fundamental conflict is exactly why so many people sitting on cash right now are about to feel some serious pain. And that leads us to the single most important question of this entire explainer. The Fed is basically telling everyone that rate cuts are coming. So is that high-yield savings account, the place you thought was a fortress of safety for your money, is it actually a trap, just waiting to spring shot the second those rates start to fall? Yeah, a trap. That's exactly what it is. Because look, while getting 4 or even 5% on your cash feels fantastic right now, you have to understand that it's temporary. It lulls you into this false sense of security while a much bigger, much more dangerous risk is building just beneath the surface.
Okay, let's just look at the cold, hard numbers for a second, because they don't lie. Even with today's so-called high yields, the reality is pretty rough. Your average savings account pays basically nothing, and all the while, inflation is just chewing away at your savings at a rate of 3.6%. The bottom line is your cash is losing its actual buying power every single day.
And this is the trap snapping shut. The second the Fed starts cutting rates, the yield on your savings account, on your money market fund, it's going to fall off a cliff. You'll be forced to take your money and reinvest it at rates that are way, way lower. This isn't a guess, it's a guarantee. It has a name, reinvestment risk, and it is the #1 threat to anyone holding cash right now.
So, if cash is a trap, how the heck do you get out of it? Well, you have to start looking at a different part of the market. We need to talk about bonds, and more specifically, the one fundamental rule that makes the whole thing tick, what I like to call the bond market's seesaw. All right, if you remember one thing from this whole explainer, make it this. Picture a seesaw. On one side, you've got interest rates. On the other side, you've got the price of bonds that already exist. Now, when interest rates go down, the value of older bonds, the ones that are still paying out a higher interest rate, well, their price goes up. And of course, the opposite is true. This simple inverse relationship is the engine that can either make you a lot of money or completely wreck your portfolio. So let's make this real. Look at these two scenarios. On the left, we've got good timing. Let's say you bought a bond that pays you a solid 5% coupon. A year goes by and the Fed cuts rates. Now, new bonds are only paying 4%. All of a sudden, your 5% bond is the hottest thing on the market. Everyone wants it and its price skyrockets. But now, look at the right side. Bad timing. You bought a bond paying just 3% when rates were super low. Then boom, the Fed hikes rates to 5%. Your 3% bond looks pathetic, and its price just falls through the floor. See, timing is literally everything. Okay, so if timing is the absolute key, how do you know when to make your move? Well, it turns out the market gives you a giant flashing signal. It's not some big secret, but you have to know how to read it, and it's called the yield curve. To put it as simply as possible, the yield curve is just a chart. It shows you the interest rates you can get on bonds for different amounts of time, from short-term to way out in the future. But what it's really showing you is the market's collective guess, its prediction for where interest rates are going next. So most of the time, this is what you see, a nice, healthy, upward-sloping curve. And it makes total sense, right? You expect to get paid more interest for locking up your money for 30 years than you would for just 1 year. You're taking on more risk over time, so you should get a higher reward. This is the market's normal, happy state. But then, every once in a while, the curve does something weird. It flattens out, or even crazier, it flips upside down and slopes downward. This is rare. And this, right here, is your signal. When you see this, the bond market is basically screaming at the top of its lungs that it expects the Federal Reserve to cut interest rates in the future. It's a massive tell. All right, let's put the pieces together. The problem is that reinvestment risk. The signal is that weird inverted yield curve. So what's the strategy? Well, you've got to think of this as a race. It's you against the Fed in a race to lock in today's high yields before they completely vanish. And hey, don't just take my word for it. This quote from the source material says it all. This isn't some crazy new theory, it's a time-tested indicator. A flat or an inverted yield curve is the market literally telling you, hey, the window to buy bonds at a great interest rate is open right now, but it is not going to stay open for long.
So, how do you actually win this race? Here is your 4-step game plan. Step 1, you wait for the signal, that flat or inverted curve. Step 2, you stick with quality. Start with the safest stuff out there, US Treasuries. Step 3, and this is the most important move, you extend your duration. That just means you buy bonds with longer terms. Think 5, 7, maybe even 10 years. By doing this, you are locking in today's amazing rate for years and years. Finally, step 4, you just hold on and collect those nice, steady coupon payments, totally insulated from whatever rate cuts are coming down the line. So you might be asking, why longer bonds? What's the magic there? Well, it all comes down to this concept called duration. The easiest way to think about duration is like leverage. The longer a bond's duration, the more its price is going to jump when interest rates fall. So by buying longer durational bonds right now, you're not just locking in a great income stream for yourself, you're also positioning yourself for a pretty nice pop in price when the Fed finally makes its move.
Look, we've laid out the winning game plan, but to really, truly understand why it's so important, we have to look at the other side of the coin. We have to talk about the huge cost of getting the timing wrong, a mistake that, sadly, a lot of investors make again and again and again.
And this is the brutal truth, honestly. Most everyday investors get it completely backwards. They totally ignore bonds when rates are high and attractive. But then, when rates hit rock bottom and the Fed is about to start hiking them, that's when they pile into long-term bonds, locking in these pathetic yields right before that seesaw tips against them and just crushes their investment. So what does that look like in actual dollars? Let's use the example from the source material. If you bought a $1,000 bond with a low coupon and then interest rates rose against you, the market value of that bond would crater to just $864. That's a direct loss of $136 from your original investment. Gone.
And please don't think of this as just some paper loss or a number on a spreadsheet. If you need that money for anything, a medical emergency, a down payment on a house, your retirement, and you're forced to sell that bond, that becomes a very real, very painful loss of your hard-earned capital. It's a permanent dent in your financial future. Okay, let's bring it all home. What are the big things you need to remember from all this? First, that old saying, cash is king, well, it's a really dangerous idea when rates are about to fall. Second, that bond market seesaw we talked about, it means falling rates can actually lead to big price gains for you. Third, a flat or inverted yield curve. That is your starting pistol. That's your signal to act. Fourth, extending your duration is how you lock in these great yields for the long haul. And finally, and maybe most importantly, good timing protects you while bad timing will crush you. Which really leaves us with one final question you need to ask yourself. The starting gun for this duration race has already gone off. The Federal Reserve is telling you what it's planning to do. So, is your portfolio on the racetrack, ready to lock in these yields for years to come? Or is it just sitting on the sidelines, trapped in cash, about to watch its returns just evaporate? The choice, right now, is yours.